I'm Jay Taylor. I'm the editor of Jay Taylor's Gold Energy and Tech Stocks. I'm here at the Metals Investor Forum in Vancouver. It's September 29th, 2018, and I'm really pleased to be with Michael Williams. He is the president and CEO of Vendetta Mining Corporation, a company with a very exciting, market doesn't seem to think it's exciting, but if you look at the fundamentals, a very exciting project, a zinc-lead or lead-zinc project in Australia. Thanks for joining me.
Thanks for having me, Jay.
Very good to meet up with you again. Your flagship property is the Pegmont lead-zinc project. Maybe before we get into that, I should mention that you trade under the symbol VTT, I think 145 million shares?
Yes, correct.
Something like that, but a large number of them, I think 32% or so, is insiders or people close to the company?
Insiders, and we also have a good institutional following too. RCF is our largest shareholder, and several European institutions that like the base metal space.
Like the base metal space. And 19 cents, something like that I saw recently.
Yeah, we recently closed at 19 cents.
19 cents and about 28 million market cap then, something like that.
Yeah, it's been it's been frustrating. We've been producing results for the last 3 years, and ostensibly we've tripled the resource since we acquired the project in 2014. We like the lead zinc space. We saw some opportunities there due to the mine closures, which have since happened, and we did see a run in the lead zinc prices, but what we didn't see is a corresponding lift with the base metal companies. But having said that, I think what we're going to see going forward, and you're starting to see it now, is what is a sustainable price of lead zinc? And it's certainly higher than when we initially acquired the projects. And I think going forward, you're going to see a lot higher than we've historically seen. And we've always internally modeled the project at 90, 95 cent lead zinc. So it stress tests at these metal prices. We've always maintained, and our PEA is out next month, we're using long-term consensus metal pricing, which essentially means I think we're fine on the economics of the project moving forward. I'll be able to tell conclusively next month, but when it comes out.
When it comes out.
Yeah, but we're going as a standalone.
Right, so you not only increase the size, I think you've also, your open pit potential is larger than it was earlier, and also I think overall the grades are somewhat better?
Yeah, the grades, we've gone from inferred resource to indicated, the grade's gone up, but the grade's gone up of about 1% overall. But initially what we thought with the project, what it's saving grace is, it's in the heart of infrastructure. So we knew right away what approximate tonnage we need to reach in order to demonstrate economics. And our goal was to get to 15 million tons and be able to demonstrate we could mine on our best 10. We're currently sitting at 14 million tons, but 2/3 of them, or 9.5 million, 5 million in indicated and 4 inferred, are in open pit category, which is a significant lower cost. It changes the overall economics dramatically, having that open pit. And so fortuitously, it's going to be our first 10 years of mining is open pit, and then we'll head underground. Now, there will be a little bit of underground blended in with that in probably years 2 and 3, we think, but those underground are also our higher grade zones, and they're very close to the open pit. So it's the capital cost for this project is in our mind, I think it's going to be reasonable.
So you might have a pretty quick payout if you're able to mix some of that higher grade stuff early on. Very
much so, yeah. And the fact that we can access the ore through the open pits, the payback should be relatively quickly.
Now your economic study will be done on a standalone basis?
Correct.
Because you have a couple of hungry mills, I believe, somewhere close by that might be very much interested in your mill feed.
Well,
in your mind.
If you look, we're located in the Mount Isa area, and Pegmont's 25 kilometers from a very big mine called Cannington, which is owned by South 32. I think they're a $20 billion company, and Cannington is on a declining grade curve. Their goal was to take their production from 3.2 million tons to 4. They're currently at 2.4. They've had some issues underground. They could have another 20 to 25 years open pit. They're constrained underground, so they can't add any more ore through their current operations. But the problem they have, their open pit has a high strip ratio, and I think the value is probably less than Pegmont. So if you look at it from a pure arithmetic basis, the Pegmont ore is more valuable. But so it makes sense for them, and I don't think we're saying anything out of school, our metallurgy lines up with theirs. We use the same metallurgical, at their blessing, they told us how their met worked, so we had our metallurgist. So we have a complementary concentrate for Pegmont and Cannington.
Yeah.
So it makes sense on paper. I think it's just a case of valuations.
Yeah.
We went standalone because we wanted to demonstrate this thing is robust enough should we want to put it into production ourselves.
Yeah, right.
But there's another mill 25 kilometers in the other area owned by a Chinese group that's out of feed that could also run Pegmont, 2 million tons per annum. I think we're, in our PEA, we're saying we'll be running about 1 million tons per year, so there's a perfect fit for that. We've got an agreement with them to use their strip, and our construction facilities will be out of their camp, so we're close with those guys as well. We don't need 3 mills within 25 kilometers.
No.
We could, but we won't, so we'll see which way we go.
Right, exactly,
You
and
know.
obviously the economics would be greatly enhanced if you didn't have that upfront cap cost.
Yeah, look, I think I'll know if you can ask me in a month, I'll tell you exactly, but
Yeah.
I would think you're looking at probably the 40-60% cheaper or less by going to an existing mill than having to build it yourself.
So your timing, again, is within how soon?
3 weeks, 3 to
3
4
weeks,
weeks.
my
4 to
goodness,
weeks.
so before the end of this year.
Yeah, I would say, you know, the engineers are telling me 2, and engineering parlay, it's 4. You know, so
Yeah.
it's double.
Well, that's, I think that's really exciting. And you know, I have to ask you this because I haven't heard you talk about it lately. I know there was a copper project in Australia not far away. Not a real project, it was an exploration.
Oh, on our project?
Yeah, well, yeah, you had one.
Yeah,
What's come of that?
we drilled one hole into it. I think the drill was at the wrong angle. It was exceedingly high grade. It was sort of we weren't expecting to hit copper there. It was a joke when remember the Beverly Hillbillies when Jed missed the possum and hit the oil.
Hit the oil.
It was kind of like that. So we need to follow it up. We put all our efforts this year into getting the PEA out, but I think next year one thing we'll be doing, we can stand back a little bit now, and once we've determined the economics, we're going to determine, okay, how big can Pegmont be, and are there any other sister deposits close by, and we'll definitely go after the copper.
You know, I think one thing that should be mentioned to the viewers is that you have a pretty outstanding group of mining professionals, and I met Peter the other night. He's really very impressive background.
Yeah, well, you know, I think we talk about the toughest thing to find in minerals. It's people in our industry, truth be told.
Good.
Peter is a mining engineer and a geologist, but he spent 7 years with Robert Friedland in Mongolia doing all the underground development at Oyu Tolgoi. But a very creative engineer, but everything's focused on economics. And it was Peter's idea to come up with Pegmont. And what he essentially did, he said, I remember him saying, he goes, look, I think we've got 4.5 million tons here. He says, I can build a mine plan and I can show how we can drill to fill that mine plan to be economic. And that's exactly what we've done. And we hit his targets. So yeah, I always say it's like being in a rock band. I'm the singer. He writes the music. He makes me look good.
Very, very impressive guy.
He is an impressive
and he's a big guy.
Yeah.
I mean, we were at a steak restaurant, and I mean, this guy was putting down steak like this. You know, it's just incredible.
Yeah, the guy works to 3 in the morning. He needs. We need to feed him. No, he's one of the smartest.
Really nice guy too. Really.
Oh, he's first rate. He also does the peer-to-peer analysis for Lundin Mining, and he's a consultant for Dundee Precious. So, you know, Peter is. I think he's one of the top mining engineers out there, and he's perfect for our space. And he's what this industry needs. He puts economic parameters, and you know, we've put $7.5 million into the ground, and it'll be interesting to see how we monetize this asset. But I think we'll do well by the shareholders.
Well, I think so. I mean, the shareholders haven't gotten much out of it so far. I think I bought some shares some time ago, and I think I'm maybe break even. I don't know, maybe down a little bit, but the values are going to be there, I think, relative to the current market cap. That it could be like a hockey stick on the chart.
My sense,
you never know.
When I get the PEA out, I can then demonstrate what the
Value.
comps are and the value, and it allows me to go talk to the right people that would like something like a Pegmont, because I hope we've de-risked it then, and I can demonstrate it, and I can demonstrate upside in this market. It's a tough market.
It sure is.
But you know, I always think value is eventually recognized, and I think we're fine.
I absolutely believe you are.
Appreciate
Thank
that.
you very much.
Hey,
It's
thanks
really
for having
good chatting
me.
with you.
You too.
All the best.
Thank you.